Hi there, folks. This is Sam Price, and we're here for another episode of Probate Notes. And I have on with me my fellow TexCom member, Justin Miller. He is National Director of Wealth Planning with Evercore Wealth Management, and he's going to tell us a lot about the income taxation of trusts and estates. Hi there, Justin. How are you today?
Hi, I'm great. Excited to be here and always excited to talk about fiduciary income tax.
How fun. We could geek out together. Okay. So first off, what I would like to know is just a bit about your background. How'd you get to where you are today?
I'd say it's a mix of hard work, a lot of luck, being in the right place at the right time. I started, I went to Berkeley undergrad, go Bears. Then I went off to law school at NYU. I have a LLM in taxation from NYU. I started off at sort of the big law firm route, which a lot of people do. And then from there, after, you get to a point where do I want to, become partner? Do I want to have this as my future career? Or do you want to do something a little bit different? And it was at that point I kind of moved into the financial services industry where I could take sort of that legal background, that tax background, but just kind of work on it in a different environment where I work closely with other lawyers and accountants.
Oh, cool. Okay. What year did you graduate from NYU?
I finished in 1999, so the 1900s.
No, I was the year after you. I graduated in 2000. Yeah.
Good
Okay.
school.
It was. I loved it there.
Go
Um,
Violets, I think.
that's right. Violets. Do they even have a team? I don't even know.
I
They
think
probably
there's the
do.
best, but I would get confused because they have two masks. There's a bobcat and a violet, but that's okay.
What are some of the deductions that are allowable to reduce the income, the distributable net income of a trust or estate?
Really, this is where we would compare it to individuals. Very, very similar. If you're talking about, state and local taxes and things like that. But one thing trust and estates get that is so much better than what we get for individuals is that trust and estates get to deduct their administration expenses. These are expenses, the term would be not commonly or customarily incurred by individuals. So as individuals, we used to be able to deduct what we called miscellaneous itemized deductions. That's been basically has gone away. Now, as individuals, even if you itemize, you get no benefit from miscellaneous itemized deductions. But trust and estates have special deductions. If the only reason you have that expense is because you have a trust or an estate, you still get to deduct that. So things like attorney fees, accountant fees, because you're not preparing a 1040, you're preparing a 1041. It's a special tax return. Trustee fees. But the one thing that you can't deduct, whether you're an individual or trust or estate, would be something like investment management fees. This actually, believe it or not, went all the way to the Supreme Court. 2008 case. It was the Michael Knight case. And for all the older people listening, this is not the Michael Knight from the Knight Rider TV show. Yeah,
Kid, I
totally
need you.
unrelated. But anyway, what that case said is investment management fees are not unique to trust and estates. Plenty of individuals pay for them, have investment managers. So that's not a special deduction. But all these other administration expenses, they fall under the code section 67E. They're special expenses, and that allows you to reduce your taxable income. So while you're allowed a trust or estate, very similar deductions that an individual would get, you get the benefit of these extra deductions too.
So if we distribute the income to a beneficiary heir of the trust or estate, then that would reduce the income to the distributable net income to the trust or estate, which would then be able to have more money coming to the heir or beneficiary.
Yes. And now don't get me wrong, a lot of beneficiaries would prefer to get the money tax free, depending on who the remainder person is. Meaning, if my parents set up a trust for me and it all goes to one of my siblings after I die, I'd rather get as much money as possible. I don't know. I mean, I love my siblings, but the reality is, I don't want to pay tax on anything. Why would I care if it reduces what's left for my siblings? But that's not how the rules work. The rules are very mechanical. And so to answer what the point you're getting at, and that is, if unless it's a special exception, like what a specific gift, a one-time gift or something like that. In general, if you're making distributions out of the trust, they carry out tax consequences with them. Now, it's the same character. So if you have rents, it's ordinary income. If it's dividends, it's dividend. The one thing, though, that's typically taxed at the trust or estate level, unless a special exception applies, capital gains.
Capital gains. Okay.
Capital gains, as a general rule, one of the big exceptions is the final year of the trust. Final year of the trust, capital gains go out to the beneficiaries. There are some exceptions that allow you to send capital gains to a beneficiary during the trust term, but the general default rule is capital gains are automatically taxed at the trust or estate level unless an exception applies.
So that exception is an important one that I think you said, because if we're typically having a probate estate, there's usually only a first and final tax return. And that income tax return isn't the 1040 that you and I file every year. It's a 1041, which is a fiduciary income tax return. There's only going to be one for a typical probate estate. Can we talk a little bit about the tax year? Because what are the rules about a trust or estate choosing a fiscal year as opposed to a calendar year for its tax year?
So a trust technically has to be calendar. A trust has to be calendar, and a state is allowed to pick a fiscal year. And without getting too much into the weeds, but a fiscal year can have benefits from a timing perspective of when we include and all that. But notice my comment earlier about a trust, the trust having a calendar year, but there is this super special election. Like I said, it's all about exceptions to the rule. Even though the estate is the only thing that's allowed to elect a fiscal year, if you've got, let's say, a revocable trust in California, of course, this is a way to, avoid probate. It's good for incapacity. So anytime you have a revocable trust, you can make an election to treat that trust as part of the estate for income tax purposes. And this is something you're going to do. Now, I'll tell you at the end why you don't do it all the time, but it's going to be an election you probably want to make most of the time because it's very efficient for tax purposes. Now, it doesn't last indefinitely. There are rules. If there's no estate tax return, you can do it for 2 years for the trust. So you can treat the trust as part of the estate for income tax purposes. So you can do it for 2 years. If there is an estate tax, then you can do it until 6 months after the final determination of estate tax, if you're filing an estate tax return. That brings up other issues, which we won't get too much in the weeds of. How do we know when that final determination has been made? That's been a sore spot for people with the IRS recently. But in general, you can treat a trust as part of the estate for income tax purposes, meaning you can take that fiscal year for generally 2 years if there's no estate tax return, or 6 months after the final determination of estate tax, if there's if an estate tax return. And like I said, this is why, think of it. I mean, you're reducing compliance costs, simplification. You get deferral benefits with the fiscal year if you have an estate. You get some special S corporation rules, passive loss rules, deduction for amounts permanently set aside for charity. So you've got a lot of extra bells and whistles for making that election.